Guys, it's not looking good. Evolution AB minus 16% on the opening of the market after releasing a terrible Q1 earnings, like really terrible. Okay, the stock falls 17%, year to date 20%. Revenue expectation were for 543 million euro. The real one was 521 million. It's not usual that they are disappointed like this, okay, especially at this point. When they are considered as a growing company. Here you will discover everything in this video, everything you need to know about the last report. The EPS expectation were €1.38, we had 1.24. So they missed everything. They basically missed everything. So you will discover everything in this video, and we'll as well talk about the CEO comments during the video. Right before jumping in all of this, just let me take 30 seconds of your time to present you Margin. It's the app that we've been working on since the last few months, and we're about to release the V1. In the V1, you will be able, obviously, to find a lot of stocks and to do analysis. You will have here the key metrics. I think they are very, very helpful. It's all the way I use them. You can easily access to the stock-based compensation to free cash flow, CapEx to operating cash flow. You have some efficiency here. You will be able to find fast if a stock is interesting for you or not. But in the financial, you can have access to 30 years of data. For example, you can take the total revenue, and we go till 30 years for each company. So this is really something useful. You can obviously add many things on a chart like this. You can compare the net income with the growth of the total revenue and so on. You can have a view with the pop-up when you want to get inside one, see the growth, how the growth have evolved, and so on. We have 30 years for net income, for income statement, balance sheet, cash flow statement, ratios, and obviously valuation, our valuation models that you liked, okay, the DCF. A lot of people ask me how we do this DCF, so I posted a video how we do, and we have it integrated here to do the valuation for the companies that you will be interested in. And the best thing I like with this is we can save the model every time, so you don't have to do again the valuation every time you come back. So if you want to join the waitlist to have an early access, we'll have open only 20 spots for the first release. You can click in the link in the description and join the waitlist. We'll tell you at the moment it will be live for everybody. Okay, so let's get back to Evolution earnings that are really not good. First thing, let's get into the growth. We have a revenue growth of 3.9% and 6% without FX. Okay, we could say that 6% is fine, is where it was, but it's low, okay? The EBITDA grew by minus 1%, so decreased by 1.1%, EPS by almost 3%. And what I don't like is operating expenses grew by 9.4%. This I don't like. I don't like operating expense growing faster than revenue, okay? It means that the company is getting less margin. On one hand, it's normal. It's normal because they want to open in the US. They have different way of functioning with the regulation in the US. So it's normal that operating expense grow, but we didn't expect that they will grow that much faster than the revenue. Because in the US, you need to have studios in each state. You need to hire certain people and so on. So it's way more, there is way more cost than opening studio in Philippines, in Colombia, in Georgia, Romania, and so on. So that's why we expect to have decreasing margin because of this. But the problem here is we expect as well to have higher growth than 4%. So yeah, this is the first problem. Margins. EBITDA margin went from 69% to 65.9%. The problem here, it's 65.9%. It's lower than the lowest estimation, or the lowest guidance from the CEO. They expected between 66 and 68%. We're under 66%. Not by far, but we're under 66%. Operating margin decreased from 62% to 58%, which is not really good as well. But let's keep in mind that a business with 58% margin is operating margin is pretty good. Okay, we don't see this a lot. The only problem is if it decreases too much or if it decreases faster than the revenue is increasing, we don't like this because it means that potentially the net income will not increase. So why do we want to increase revenue in a business if after we don't have an increase in net income, we don't really like this. In terms of capital allocation, when we see the result of this quarter, we understand why they didn't do more buybacks last quarter, because they needed the money for something else, okay? They still have a 500 million euro program for the year, but to be fair, the way they are going, I don't expect them to use all these 500 million in buybacks. We will see, but it wasn't very convincing. The guidance, they maintain an EBITDA margin between 66% and 68%, okay? They maintain this guidance. So yeah, this is something that we need to take in consideration. Maybe it was just a bad quarter, but yeah, like the quarter is really ugly, especially when we take in consideration the new CFO, which is, I'm not saying incompetent, but which we have a lot of doubt. Now we have the annual general meeting on 14 April. Like if they announce that they want to open or they're opening on the US market, okay? They are quoted on the New York Stock Exchange, Nasdaq, whatever. If this happens, it will be good. And we will understand why they picked this CFO, because he is American. So the CFO was probably well placed to help them to have a quotation in the US. But they don't have the quotation in the US. Like, why the fuck did they pick this CFO? Like, why? I still don't understand it. And that's why I'm not starting to be worried, but we really need to have better results on the next semester, okay, the next quarter for the first semester, because last year they told us, okay, we should see a great improvement from Q3, Q4 in the next semester, okay, at the second part of 2025. So now let's say it's normal that the first part is not that good, okay, even if it's way less good than what was expected, let's say it's normal. Now we really expect to have better on the next quarter and the quarter ahead, because if not, it may be problematic. There is still some good points that are finally not that good. You will understand why. There is a third studio open in New Jersey, second studio in Romania, 17 new RNG games, okay, and 1,000 new employees in Michigan only. So on one hand, this looks like good news, okay? They continue to develop, they continue to create games. But with 17 new games, new studios and so on, why the revenue is not getting higher? Why the revenue is not growing faster? Why doing all of this if it's not to have a better revenue, okay? So maybe it's because they are brand new, so there is still a lot of expense around this and so on. But yeah, I'm not really convinced. Let's be honest, this is bad, okay? It's a bad quarter, okay? It's a very, very bad quarter. Now let's look at some notes that I picked from the CEO here, the CEO comments. First one, he acknowledged it, okay? A cautious action we have taken that will be beneficial for the business in the long term. This with a decelerated growth rate in the quarter is not only impacted by the development of the currency rate, but also connected to cautious action. So if this is not lying, okay, if this is what he's saying and he's not lying or he's not turning something bad into something good, it means that the moat will increase for the company. If the moat increase, we are good for the next year. But again, if you want to outperform, you need to pick. The difficulty in outperforming is not only to pick great stocks, it's to pick great stock at the great time. And now on the market, you have so many opportunities that, okay, maybe Evolution will be a good company to outperform over the long run. But for the next 1, 2, 3 years, we may really underperform, and you need to accept that you may underperform during this time. Firstly, we're addressing the ongoing issue in Asia, where we're implementing technical countermeasures to stop the criminal cyber activity. So they still have those problems in Asia. They said last quarter that it should be done second part of 2025. They should be done with it. We will see if they manage here. That's why I'm not selling my position. That's why I keep my position, is because I will consider something after in the second part of the year. For the first part of the year, we knew it will not be that good, but we just didn't expect that bad, okay? So that's why I'm waiting. They're also done in the UK to meet regulatory requirements, okay, so that's the advance. The long-term picture remains intact. Regulation is positive and attract new end user over time. So if this is true, it's very good. It's very good because they are growing well in the regulated market, and it's actually creating a good moat for them, because if they are one of the only with good numbers on regulated market, that's good, because others will not be able to enter on the market. So this is very good. We believe that the action we're taking also will impact the second quarter, but the second half of the year will be stronger. Okay, this is what I'm waiting for. Okay, the second quarter is, say clearly, don't expect it to be good, but the second half of the year should be good. It keep the estimate margin of EBITDA 66 to 68%. Okay, we will always prioritize growth over margin, which is why we are continuing to invest also in times when we see short-term disturbance to our business. The only problem with this is saying this while having only 3% or 4% growth, revenue growth, like, oh, it's not really what we want to hear. Okay, I'm sorry, but you could, as a CEO, you're just telling like, oh yeah, we focus on growth. Growth is the most important thing, but then you don't have growth. You don't give us growth. We want to have growth. So this is where I see some problem here. Product roadmap ever with more than 110 new releases, okay, for 2025. We'll see how it will go. It can be noted that we have seen a jump in the total share of net revenue from regulated markets, which now stand at 45%. We have launched a second studio in Romania, a third studio in New Jersey. The studio project in Brazil and the Philippines are on track for launch in the second half of 2025. And we also opened a second studio in Michigan, USA during autumn. Okay, so this is good. Like, they continue to open, they continue to develop, they don't stop this. Okay, so it's good. Apparently the strike is now a closed chapter, the strike that they had in Georgia, so this is done. Something which is actually something interesting is, first, they employ 22,000 people, but 85% of the supervisor and manager vacancies are filled by internal promotion. So they give some perspective. On the one hand, they hire people which are not qualified, in a sense that it's, for a lot of people, they are young, it's their first job and so on. So it's a first step in the active life. But they still have some opportunity to be able to grow in the company. To what point they can grow, we don't really know, but they can be supervisor. So it's still something a bit motivating for them to work well. Like, they will see that, okay, if I work well, I can be a supervisor. They will not hire somebody from another company and so on. So this is good. Here, the hand word, I am not happy with the financial development in the quarter, but one must take into account that the results are impacted by necessary steps that contribute to our mission to ever increase the gap to competition. So, yep, that's all for the thing. The thing that I keep in mind here is, with what's happening now for this quarter and probably the next quarter, is either, on one hand, it can increase the moat. If it increases the moat, probably when we look back in 5 years, okay, and we look back to now, we'll say, oh, thank God they did this. Thanks that everything went like this, because now the company is stronger than ever and it's able to continue to grow and give great shareholder value. On the second hand, what I don't really like, and what can be also the thing, is they really have a lack of idea to grow. They try to launch new game, to open new area and so on, but still, no matter what they do, they still don't grow, but the operating expense grow. So we can have a world where the revenue grow by 4% per year and the operating expense continue to grow by 9-10% per year. So which means what, we'll have less profit, and this is not really good. They keep the dividend, okay, 52% payout ratio for the dividend. To be fair, like, they could decrease it, like they could do cut it in half and do buybacks instead of dividend. To be honest, like, especially with the tax in Sweden about dividend, I think you have 35% withholding tax on dividend. So, like, to be fair, it would be better if they just cut the dividend or cut half and do buybacks instead of this. But we cannot really expect something like this with the CFO that they have. Like, let's just hope this guy will be good. Okay, just don't have a good track record. Let's hope he will manage to make Evolution listed in the US, and that's why he was here. And then they will pick somebody more able, let's say. We don't know, okay? we'll see what will happen. But for sure now the company is still undervalued. It's just like a really, really bad quarter. That's all for this video. Let me know in the comment section, what do you think about Evolution AB? What do you think about this quarter? Do you still have it in your portfolio? Are you selling? Are you buying more? What do you do with this? Do you have some information maybe that I missed and that can be very interesting? So let me know in the comment section. The goal is to be better investor. So we'll be happy to read all of this.